5 is up there now. I didn't get a chance to put chapter 6, so I'll put Monday's lecture along with today's stuff that I'm recording now up a little bit later. Okay, now we understood last time that the difference between variables versus absorption is the way we treat manufacturing fixed cost. Under variables, we expense all fixed cost. Of course, we always expense the selling and administrative expenses under both absorptions and variable, but under variable, we go ahead and do what? Also expense the fixed manufacturing cost as well. Under absorption, the fixed manufacturing costs are not automatically expensed. They are included as part of our inventory until we finally do what? Sell those inventory items, at which time the fixed manufacturing overhead that are included in our inventory are released from the balance sheet and then end up being expensed on the income statement. So when we look at the difference between our variables and our variable and our absorption, we really need to analyze the inventory account. And if the inventory account increases for the period, then our absorption is going to have a higher operating income. If our inventory levels decrease for the period, then variables will have the higher operating income because they've already taken the fixed cost in another period, right? And absorption is releasing them in the period that the inventory levels decrease. If inventory levels increase, then I already said that. If inventory levels stay the same, then there really will be no difference between variables and absorption. Okay, so let's just go ahead and practice here, see how that works out with this example. And we have the situation. I'll go ahead and just put this in slideshow. We have the situation where we have this Harvey company, and we saw the facts earlier from them that they produce 25,000 units a year. And in this example, they actually sold more units than they produced. Now, when we looked at this last time for year 1, Harvey had done what? Harvey had produced more units than it sold. Now they're going to sell more units than they produce. So they have 25,000 number of units produced. They sell 30,000. So they're going to be selling some items. Is there a comedy going on that I don't know about? There's some units that they're going to go ahead and do what? They're going to go ahead and sell some of those units in beginning inventory. And when they do, the cost, the fixed manufacturing costs that are included in beginning inventory are going to be released from the balance sheet and be reported as an expense for the period. So absorption, or not an expense, but cost of goods sold. So absorption will have a lower net income than variables. Okay, so again, just to remind ourselves of the fact pattern here, sales price is $30 per unit. Our direct materials, direct labor, and our manufacturing overhead, the variable, are $10. Our variable selling and administrative are $3, and our manufacturing overhead, our fixed costs, our manufacturing overhead, and our selling and our administrative, manufacturing is $150. Selling and administrative is $100,000. Okay, so we come over and we start to look at how we're going to break out our product cost here for our two different methods. And notice the difference is how we treat what? The fixed manufacturing cost, which is our fixed manufacturing cost for the period divided by the number of units produced, the 25,000 units. So absorption has what? A higher product cost, right? And those product costs sit on the balance sheet until we sell those items, at which time they will be released from inventory and be reported as a cost of goods sold. So you come over and you take a look at variables. Now variables, remember, only had the $10, right? We pick up that $10 times the units sold. That gives me a variable cost of goods sold of 300,000. My variable selling and administrative, they told me it was $3 per unit. I will always expense those under both methods, right? Both absorption and variables. So I have my variable cost. That gives me my contribution margin. I take out all fixed cost under variables. Does not matter if it is a manufacturing cost or a selling and administrative. I take all fixed costs, right? And that gives me then an operating income of 260. Okay. Now, if I look at that same fact pattern now and I do that for absorption, notice what happens. Notice that my manufacturing costs now include the fixed manufacturing cost for the period, includes the $6. So I have this 900,000 minus the 30,000 units times the 16. That gives me my cost of goods sold of 480. That gives me my gross margin or gross profit of 420. And then when I subtract my selling and administrative, it's only the what? Selling and administrative, both fixed and variable, right? We always expense all of our selling and administrative expenses. That gives me total selling and administrative expenses of 190 off of my gross margin, gives me a net operating income of 230. So absorption had what? $30,000 less net income than did variables, and that happened because what? We had 30,000 units that, I mean, not 30,000, 5,000 units that were released from beginning inventory that were sold this period. So those costs were sitting what? On the balance sheet, and now they have gone over to the income statement in the form of cost of goods sold. We had taken those costs, what? Last period under variables, when variables had a higher, had a lower net income than absorption did, right? Because at that time we were storing those costs for those 5,000 units on the balance sheet under absorption. Now we've taken them into the income statement, so we have this $230,000, $6,000, $30,000 less than my variables. So if you look at the difference between the two, the difference will always be explained by what? By the change in inventory for the period multiplied by the fixed manufacturing cost, right? Whatever the change is, that will account for the difference. So in this case, since the inventory levels went down, we take the variables, we subtract the increase, the decrease in inventory for the period times the $6. That gives me the absorption net operating income. Okay. Now this slide is a good slide to look at often and make sure that you are satisfied with it, because this is going to be the way you'll answer most of the questions that we'll be seeing coming up here on the next couple slides, and we'll also look at a couple more when we go through the quiz. Okay, so what happens? If units produced and units sold are equal, there's no change in inventory, there is no difference between variables and our absorption. Okay, they will be the same. Okay, if the units produced are more than the units sold, now what? Now we're going to have those fixed manufacturing costs per unit that are going to be sitting on the balance sheet waiting till what? Till we ultimately sell those items before they make it over to the income statement to be part of our cost of goods sold. So if that's the case, absorption will have a higher net income than variables, because the variables get expense all fixed, even if it's the manufacturing, right? Overhead fixed costs. Okay, if the units produced are less than the units sold, obviously that means our inventory will decrease. Inventory decreases, now what? Now those fixed manufacturing costs per unit that were sitting on the balance sheet are going to be what? Released and reported as a cost of goods sold on the income statement. Variables would have taken those costs last period, wouldn't have they? So the variable method will have a higher net income than absorption. Question? Okay, good. So we come over and we take a look at this. And we had done this question. I don't know if I can make that any bigger. We had done this question at the end of class, towards the end of class last time, but I thought it was kind of premature and that we hadn't had this full discussion yet. So just let's look back at this one. And I think it's moved up in the slides if you're trying to find in the slides that I just stuck it here before class. So the version that you may have maybe puts this question up a little bit further. But Uville Corporation produced a single product. At the end of the company's first year of operations, 1,000 units of inventory remained on hand. Its variable manufacturing overhead cost is $45 per unit. Its fixed manufacturing cost is $10 per unit. If Uville absorption costing net operating income would be higher than its variable net operating income by what? By 10,000. It's those 1,000 units that were still sitting there in ending inventory multiplied by what? The fixed cost per unit. So it's going to be this $10 times 1,000 units. That means that our absorption will have a $10,000 higher net income than variable because our ending inventory is still holding those 1,000 units, right? At $10 per unit. Okay. All right, good. Let's take a look at this one. Last year, Walters Corporation variable costing net operating income was $68,800. Its inventory decreased by $200. Fixed manufacturing overhead cost was $3 per unit for both units in beginning and ending inventory. What was the absorption costing net operating income? And so we pick up what? We pick up the $3 per unit. Okay, we're just going to pick that up. That's the $3. They can't write it down here. I'll write it right here then. $3. And we had what? A decrease of 200 units. And so since our inventory levels decreased, we have released those fixed manufacturing overhead costs from what? From our balance sheet into our cost of goods sold, and so absorption will have $600 less operating income than variables, right? Inventory levels went down. Okay. Okay, good. Let's look at one more here. Ready Inc. manufactures a single product. Variable cost net operating income was $63,800 last period. Inventory decreased by 300 units. Fixed manufacturing overhead cost is what? $4. The 4, I don't know why I thought they wrote it down here. The 4 times what? Times the 300 units gives me $1,200 of fixed manufacturing overhead costs that were sitting on the balance sheet that are now going to go to cost of goods sold. And so variables will show 1,200. Absorption, will show 1,200 less income than absorption. Okay. All right, so let's go ahead and let's jump ourselves into the next part of Chapter 6, which is going to be looking at segment reporting. Okay, so when we look at segment reporting, okay, Chapter 6 is broken into 2 categories, and they call it segment reporting. It's really segment analysis. Like I mentioned last time, segment reporting is something that is very specific for financial reporting purposes, and so they really shouldn't call it segment reporting. Just call it segment analysis, whatever. But we'll just let them call it what they want. Okay, but let's just go ahead and take a look at what we mean by segments. Okay, when we look at a company, we could look at a segment as an individual store that's part of a chain. We could look at it as a territory. I guess this would be the Southeast Territory, whatever, of the United States, South Territory, whatever. And then we could also look at it by service center. I guess this is a hospital, and so we're going to look at, the operating room as a segment versus the emergency room or something. All of these are segments, okay? And of course, we're going to manage the company really this way. That's why, for financial reporting purposes, they have specific requirements that if a segment is big enough, it has to be disclosed. Information about that segment has to be disclosed, because they're looking at that and saying that's really how the company is managed. I mean, you know, CEOs don't sit up there with the consolidated financial statements and say, okay, let me try to manage this business. They're going to sit there and they're going to look at each segment report and try to understand what's going on with that business, right? Okay, so when we look at these, we're going to look at them in contribution statement, in contribution format. So we're literally going to have our what? Our revenues minus our variables cost, give it contribution minus our variable cost, give us contribution margin minus our fixed cost, and we're going to look at something called segment margin. Now what we're interested in is to what extent does that segment contribute to the overall profitability of the company. And if we have a segment that contributes to the overall profitability of the company, then we're going to kind of like that segment, aren't we? Right? So we're going to say, hey, let's keep it, because if we get rid of it, the overall profit of the company is going down, right? Or we could look at it and say we're going to pump most of our resources into the segment that gives us the highest contribution, is the other way to look at it, okay? Now, where they try to trick you on questions that you'll see on your test, so I guess since I'm giving you the test, I'd be the one that would be trying to trick you. Where I might try to trick you is give you something called common cost. Common costs are not traceable to particular segments. Sometimes we call them non-traceable. You should never allocate a non-traceable common cost to a particular segment. If you do that, that's faulty analysis. Step away from the analysis. You don't know what you're doing, because you are now going to make a what? Potentially profitable segment look what? Not profitable. Meanwhile, the cost that you're assigning is not going to go away if you get rid of that segment. Okay, so when we talk about common costs, those are costs that will not go away if you get rid of the segment. Now, that is not consistent with what I have up on the screen right now, which is talking about traceable cost, okay, or non-common costs. Traceable costs are costs that are traceable to a particular segment. For example, if you get rid of the computer division, then we don't need a computer division manager anymore, right? So his salary would be considered what? Would be considered a traceable cost. That's why he's so nervous, because he's thinking they're going to get rid of that segment. There goes his job, there goes his salary, right? So his salary would be considered a traceable cost. A common cost, which is not traceable, might be the CEO's salary. What happens? If you get rid of the computer division, you still need this CEO, don't you? I don't know if you need them or not. What do they do all day? What does upper level management do all day? I mean, I know they're up there, but I can't figure out what they do all day. Okay, or at least they make big decisions. Bottom line, you get rid of a segment, they're still going to be there, right? So that's considered a non-traceable. It is considered a common cost, and you would not allocate common costs to your segments, because it doesn't do you any good to what? To get, doesn't reduce that common cost at all if you get rid of that segment, right? And so you could be getting rid of a profitable segment if you were to allocate common cost to that segment, okay? So you come over and they tell us that some cost that may be traceable at one level would be considered common at another level. For example, if there is a landing fee that's charged to each plane, then you could reasonably do what? Allocate that cost to each flight, right? So it would be traceable at the airplane level, but you can't allocate that cost between first class and the regular class. When I say you can't allocate it, you could for financial reporting purposes, easily enough, the number of seats that are in each class, but you would not do that for analysis purposes. That's why I balked at the term financial reporting. If we're doing segment reporting, we absolutely will do what? Allocate common cost to each segment for a reporting standpoint. But from an analysis standpoint, you would not allocate common cost to the segments, and so it would be nonsensical to allocate part of the landing fee to the first class versus the common class, whatever. I shouldn't use the word common because we're using the word common. What do they call it? Coach. Because what? Because you can't get rid of that part of the airplane. All right? That part of the airplane is going to be there regardless. Okay? Okay, good. Or that fee is going to be there even if you got rid of that part of the airplane. Okay? All right, so let's go ahead and let's take a look at how we will analyze, and we're going to be focusing on something called segment margin. Okay? And when we do this, we'll look at our fixed costs for our contribution format, and we will take the traceable cost to each segment. We do not allocate common cost. I mean, this slide right here is telling you everything. Do not allocate common cost, at least for the contribution segment margin analysis, right? You know, for financial reporting purposes, you would, but not for the analysis that we're going to be doing. Okay, so we look at this company. It's got two divisions, computer division and television division. Okay, and so we've got the two, and we're going to go ahead and see how we would analyze these. Now, you might want to skip ahead a couple slides, guys, because I decided there was a couple of nonsensical slides sitting in, not nonsense, but proliferous, what's the word? Superfluous slides that we didn't need, okay? And so I just went ahead and just took those out, okay? But let's just go ahead and take a look at our income statement, and notice we have the company-wide, we have television division, we have the computer division, and notice the traceable fixed costs we did allocate to each division, right? Okay, because they're easily traceable to those divisions, so we do that. We have common cost here. The common costs do not get allocated because we've determined that those costs will not go away if we get rid of either one of these divisions. And so if you started allocating the cost, you could make a segment that has a segment margin that's contributing to the overall operating income of the company. You could make it look like it's a loser when in fact it's contributing, right? So you do not allocate those common costs. Okay? So once you know that, then you can go ahead and start to break this apart even more. So if you look at the television division now, you could start to break your cost into your big screen versus regular size screens, whatever. I think when they did this, they meant flat screen versus regular screen, but now there are no more flat screens, right? And so everything's a big screen TV, I guess. So big screen versus not big screen, whatever. Okay, so what happens? You sit here and you take a look and notice that the traceable fixed costs are now $80,000 when you're breaking the television division out into the big and regular screens. Notice that we had what? We had earlier when we looked at our common costs for the our traceable costs, for the television division, it was what, 90? But of that 90, only what? Only 80 of the 90 was traceable to each product. So when you dig down a little deeper, some costs that were traceable at one level become what? Common at another level. Okay? And of course, this would be important if you were trying to do some sort of analysis of, should we continue to carry the big screen versus the regular screen TVs, right? And so if you started allocating these, all of a sudden, big screen, let's say, might look less profitable when in fact it might be more profitable. Okay? So same principle now, just digging down a little deeper into the division. All right? So once we have set up our segments the way we've seen here, we can start to do some analysis with these because we have this division margin, we have a contribution margin per division, we have our fixed cost per division, and if we want to go ahead and do some sort of break-even analysis on the two divisions, easy enough, we'll go ahead. Well, first we could do it company-wide. Company-wide is going to do what? Take all of our fixed costs, 90 plus 80 is the 170. We're going to add what? The common fixed cost. So we add all that together, 170 plus 25. We add all that together. We divide it by the contribution margin ratio for the entire company. Contribution margin ratio for the entire company is going to be their contribution margin divided by their sales. That's all where that came from. That gives us a 0.54 contribution margin. We know the break-even point of the entire company, right? Okay. Now, if you wanted to come up with the break-even in dollars here, if you wanted to come up with the break-even by division, now you just pick up what? Now you just pick up the fixed costs of the divisions to figure out your break even, the traceable fixed cost. So the 90 and the 80 here for each division, right? Notice we have our sales of 3 for the television, our contribution margin of 150 for computer, our sales of 2, contribution margin of 120, right? So we go ahead and for each one now, we calculate the contribution margin ratio, which was the 150 of contribution margin for television divided by the sales for television of 300, right? And then for the computer, it's going to be 120 divided by 200. That gives us our contribution margin ratio for each one of those. And then we divide that into what? Only the traceable cost. We divide that into only the traceable cost. Now, only these traceable costs in order to determine the break even of the two divisions separately. Question? Question? Okay. Okay, good. And there you can see the overall statement where only the common costs have not been traced. I don't care about this. Okay. Now let's see what happens if we turn around and we decide to go ahead and violate what we just said and allocate common cost to divisions. Okay, so we've got this restaurant. We've got, this, whatever it is, Hooliglands, Lakeshore, Bar and Grill. I don't know what the heck this is. But anyway, it's a restaurant that has a bar part and a restaurant part, right? Okay. And so notice that we have the traceable costs going over. We don't allocate the common cost. Now let's say somebody comes in and insists, nope, we got to allocate the common cost in order to be able to figure out which one. Okay, so we force ourselves. I hit that thing so hard it changed that. We force ourselves to go ahead and come up with some arbitrary means of allocating those costs. And when we do, what happens? We start allocating costs to the bar that makes the bar look what? Not profitable, when in fact, if we hadn't allocated those common costs, we would have seen that it is contributing to the overall profitability of the company. Should we keep the bar? Well, this analysis, it looks like not, right? But that's a erroneous analysis, because even if we get rid of the bar, we still have $200,000 of common costs, and now we've lost the $14,000 of segment margin that was contributing to the overall profitability of the company, right? Now, you might do this for financial reporting purposes. If you had to report something about a segment and wanted to allocate those costs to a segment, we have to report things about segments if they meet one of 3 requirements. This segment constitutes 10% or more of the combined revenue of the company, not consolidated, but combined revenue. The segment represents 10% of the combined assets of the company, or a segment represents 10% of the profitability or loss on an absolute basis of the revenue, income or loss, profit or loss of the entire company. If you meet any one of those, it's not all 3, then you do have to report segment information. And for the reporting of segment information about that particular segment, yes, it would be appropriate to go ahead and come up with some means of allocating costs to these different parts of the business, but not for our contribution margin analysis, break-even analysis of these segments, etc. Now, what's wrong with this example? Is it realistic that a bar would have a segment margin of 14 and a restaurant having, 200 times that? Would that be realistic? Usually what, or 20 times that, whatever? Usually bars make more money than the restaurant, right? Okay, so anyway, that's not relevant to understanding this example. I'm just saying. Okay? Okay, good. So let's go ahead then. Huh? I thought I had some things embedded in there. Didn't I have questions embedded in there? No? I guess I was seeing things. Felt like one of the examples, one of the slow ones I was looking at did. Huh? Well, I'm just going to do the obvious thing and go to Canvas and get it, because I know I posted the thing up on Canvas as a quiz. Okay, so let's go ahead then and let's take a look at a couple of the segment questions anyway. Just so we see how some of those work, because I know for the other ones we obviously had them embedded, we were looking at them. Is that me? Okay, but let's just take a look. Unless you don't want to. You want to look at these? Okay. Alrighty, so let's start with number 70 here. Okay, so we start to get to these segment questions, and I thought I had embedded them in the slides, but I guess they're actually in the quiz. Okay, so you have to get to the quiz to see some of these. So we've got these two divisions, export division and the business division. And the export division divisional segment margin is 34.3. The business product divisional segment is 88.7. And the total amount of common fixed expenses not traceable is 95. And they asked for the overall company's operating income. Now let me get that one slide back, just so we can remember what we saw there. So when we sit here and look at the overall profit of this television store, whatever it was, we had what? We add up, if you add up the division margin and subtract the common cost, that gives you the overall operating income of the company, right? Okay, and so what happens? If you look at this question, it's really testing your understanding of that concept by giving you the operating income of one division. Really? Okay, by giving you the operating income of one division, giving you the operating income of what? The other division. That's the overall segment margin. Overall segment margin minus what? The non-traceable common cost gives me the overall profitability of the company. Right? Okay. Okay, good. Let's take a look at the next one. I don't know. These numbers are weird in here. Soda Corporation has two divisions, East and West. The corporation's net operating income is 92.3, East Divisional segment margin is 223,200. West Division segment margin is 15,900. What is the amount of common fixed expenses? Now, if you're looking at that statement that we had before, they're taking the 15,900. They're taking the segment margins. The 15,900, and they're taking the what? 223,200. Okay, and they're adding those together and getting the overall company segment margin of 239,100. And then they're telling you that the company has what? Has an overall corporate net operating income of 93,200. So we must have subtracted what? Something from the segment margin, and that something is what? Is the non-traceable common cost. So if you just do the math on that, then 239,100, the algebra or whatever, minus what? Minus what we ended up with, 93,200, then we must have subtracted what? 145,900 from the overall company margin by adding the two segment margins up. The overall company segment margins, subtracted the common costs, and that's how you came up with the operating income, right, for the company overall. Okay. Okay, good. Let's take a look at this. Gunderman Corporation has two divisions, Alpha and Charlie. And the Alpha division had sales of 230. This is the solution down here, guys. This is how you would answer this. 230. Variable expenses of 130. This is how you would answer this. This is not part of the problem. This is the solution, right? Okay, and then for the Charlie division, sales of 540. Variable expenses of 307. Okay, then they go ahead and they call out for us what? The traceable expenses for each, which the traceable expenses are 63,600 for Alpha, or 63,300 for Alpha, and what? 127,700 for Charlie. Okay, so we now have our two what? Segment margins. We add those together. That gives me the overall segment margin of 147,100. And then they tell me that what? Expenses not traceable, those are common, aren't they? So I subtract that off, and that gives me the overall operating income, the answer to this question of the company, right? Okay, so just a few questions there, sort of testing our understanding of how we treat traceable costs and how that relates to the operating income of the company. Okay, now you come down and we look at this Gal Corporation, and they want the break-even in sales dollar for the company as a whole. So if we're trying to do this for the company as a whole, we want the break-even in sales dollars, then we're going to take the overall company contribution margin, aren't we? So we take the 447,470, divide that by the 668,000, gives me contribution margin for the overall company of 0.67. And if I want the break even, we know this from chapter 5, we simply do what? We simply take the total fixed expenses. Okay, so maybe we don't know all of this from chapter 5, but we have to pick up all of the fixed expenses, don't we? So we pick up the what? The traceable fixed expenses and the common fixed expenses, the non-traceable, if we're trying to get the overall company break even, right? We got to pick up all the fixed expenses. And when we add those two numbers together, we get this 408, 480. And then we simply do what? We simply divide that by the company-wide contribution margin, excuse me, to give us a break even here of the 609,794. Got to pick up all the fixed expenses if it's company-wide, right? Okay. Now, if you're just trying to come up with the contribution margin for a particular segment, then what do? Let's look at this one. They want the break-even in sales dollars for K division. So they just want us to look at this division. So we take what? We take the contribution margin of this division, 116,560. We divide this by what? 248,000, the sales. That gives me contribution margin ratio of what? 0.47. Okay. Then I take that and I divide that 0.47 into what? Into the, and I only pick up what? The traceable fixed expenses here of 75,000. Because I just want the break even of that segment. And when I do that math, I get the correct answer, right? Only divided by what? Into what? The traceable for that, right? When it's just a division. If it's company-wide, I pick up everything, traceable and common. If it's just a division, I only pick up the traceable. On what? Well, because they're trying their best to screw you up. I don't know. Maybe that's the way they're doing it for they've done that for some other financial reporting purposes, but for the break even, I don't care if they can sit there and break them up all day. I don't care if God came down and said, here's the cost that should be going to each one. We do not use the common fixed expenses to calculate the break even. The idea being that what? If it's common, even if you got rid of the K division, you'd still have the entire 40,900 of common cost, right? Right? So I don't know what basis they used even to allocate these. It doesn't matter. They can sit there all day and allocate this. It's not going to affect the break even. But that's a good question. I didn't even realize they did it. I'm so used to just looking at just the traceable. I don't even know why they did that other than to confuse you. Okay. If they're allocated like that, then by definition, they're not truly common. If that was a true allocation, if it was traceable like that and that was meaningful, then it should have been treated as a traceable, not a common. Okay, that's not to say that you would never allocate common costs, because as I stated about 5 times now, for financial reporting purposes, it would be reasonable to allocate those two costs. In fact, you're required to take common costs and allocate them to a segment for a segment reporting requirement, but not for a analysis like this. That's why I didn't like them calling it reporting at the beginning. This is analysis, not reporting. Okay? Question? Okay, we're going to go ahead and get out then. Next time we will do Chapter 7. We will pick up the discussion of activity-based costing. If you came in late, you need to see me so that I can go ahead and mark you unabsent.